Welcome everyone, another episode of Financial 15, the show where Kevin and I try to provide some knowledge, try to improve your finances, and do that in 15 minutes or less. And today we're talking about withholding tax. You take money out of an RSP, take money out of a RRIF. How does the tax work? We'll get into all of that.
Yes, RRIFs, RRSPs, withholding tax. We're going to cover all of that today. We've got a variety of other topics that we've looked at. You can always find us at our webpage at beckerorr.com to see these videos or others, or go to our YouTube channel or like us on Facebook. That way you'll be able to see everything that we've got content-wise. So to start today, Clint, RSPs and RRIFs and withholding tax. What are we talking about here? When does it apply?
Yeah, so we're talking about when you take money out of those accounts, how does the tax actually work? There's what's called a withholding tax, which is a little different, can be a little complicated. We'll go through it account by account. So we'll start with that RSP. So if you're making an RSP withdrawal, I think the first question, Kevin, is should you really withdraw money from your RSP?
Yeah, I mean, that's a big one to do with, is do you need to take money out of it? As we've typically said to anybody beforehand, I mean, the RSP is probably the last place you should ever draw money from. If you have a non-registered account, theoretically, you have a TFSA or you just got cash sitting in the bank, utilize these sources first before you start taking money out of the RSP. And a variety of different reasons are there for it. One is the withholding tax, which we'll talk about. Another one would be you'll lose the room. So if you've contributed in, it's not like you can take it out and put it all back in. That room's gone forever. So those are just some of the basics. What else do we have to worry about withdrawals for RSPs, Clint?
Yeah, often people build money up in an RSP and then they might need that money for a big purchase, for example, for a home. And there is a special plan for that. We won't get into it today because it's a whole video to try and explain the plan. But the first time home buyers plan, just important to know that it exists. So if you need to take money of an RSP for that purpose to help with the purchase of a home, you can do that without the tax consequences. You eventually pay the money back over time. And that's the much easier way to tackle it if it is in fact for the purchase of a new home. So let's get into the withholding tax for RSPs. You can see the chart on the screen here. So what happens is you take the money out of an RSP, Kevin, and they hit you immediately with a tax, right?
Yes, I mean, that's exactly it. So depending on how much you want, since this is registered retirement savings plan, what they want you to do is put the money away and wait until you're retired before you draw it out. If you take it early, though, the government wants to make sure that they are getting a piece of that money because it's never been taxed. So they're going to take a percentage off. So as we can see right here off the chart, you know, if you're withdrawing $5,000 or less, 10% is going to come off. So if you take out $5,000, $4,500 is going to go to you. 500 is going to the government no matter what. And as those numbers increase, as you can see, the percentages increase because the government's got to make sure that they're taking what they consider to be their fair amount of tax based on the progressive tax system that Canadians run. Is there anything else on this that we need to know about?
Well, there's a couple of quick points here. One, this is a flat tax that comes off the front. So it's not based on your income. It is just based on the amount of money coming out of the RSP. Also, it's cumulative. So if you take $5,000 out in February, and then let's say you take $11,000 out in June, well, that second withdrawal, they're going to look at the year and say, well, if this is $16,000 for the year now, you're now in the category where they take 30% off the hop. So it's a cumulative total throughout the year. Most financial institutions deal with it in that way. Also, it's a minimum, Kevin. If you really wanted to pay 40% tax, the government will not say no. If you want to give them more money, you can do that. And the last point here, and I think this is a big one, this is not your final tax bill, is it?
No, I mean, it's definitely not. What they're doing is you're prepaying a portion of what your tax is. So, I mean, if somebody had earned $100,000 for the year and then took another $10,000 out of their RSP, I mean, you're still going to owe money on the $100,000 that you earned over the course of the year. This is just a flat tax based on what you're going to pay for your withdrawal from the RSP and the RSP strictly. So if you owe more tax percentage and you're taking out $10,000, it's only 20, but you're in a 30% tax bracket, you're still going to owe another 10% of taxes based on what you drew out of your RSP for that. And one point I do want to make on these numbers, this basically applies for most of Canada. Some of the rates in Quebec are slightly different. And if you need to look that up, that's one place to go. CRA will have those numbers for you. What else do we have with RSP withdrawals?
Yeah, so in the end, we're looking at the withholding tax, which is a flat tax that hits you up front. In the end, the total tax you pay is based on your income. You'll get what they call a T4 RSP slip. So you get that T slip, usually comes out in that February timeframe for the prior calendar year. It'll have on there listed all the RSP withdrawal you made, any tax you've already paid. Most folks just give that to their accountant. They work it into the overall tax return that gets filed. But what happens is, let's say you took 10,000 out of your RSP, you're in a 40% tax bracket. Since you took out 10,000, you paid 20% up front. Well, in the end, it'll work into your tax return. They say, well, you owe us the rest of that tax. You're supposed to pay 40, you paid 20 up front, we might need the other 20. Or perhaps the other situation is you paid 20, but you only should have paid 10, you can get a bit of a refund. So when you file your tax return, it all gets squared away. And in the end, the tax you actually end up paying is going to be based on your income. It'll be the appropriate income tax rate. So withholding is just this upfront amount, Kevin, right? The government wants to get it, make sure they get something right off the top.
Yeah, because otherwise they're worried, somebody takes out 50 grand from their RSP. If there's no tax ever paid on it, and all of a sudden something happens down the road, there's tax owed, they may not get that tax. So they want to make sure that they've got at least a percentage of what's going to go on, because as we've said, this is meant for your retirement. So it's not meant to be taken early, but we know that people will, because extenuating circumstances could come up for that rationale and reason. So that's a lot of the stuff that we've dealt with RSPs. What else do we have to talk about?
Let's move on to the RRIF. So now we're looking at a RRIF account. Quick difference here, RSP, Registered Retirement Savings Plan, or RRIF, or Registered Retirement Income Fund. So this one is designed for income. This is where an RSP goes to in retirement. You make that conversion, and the idea is you're meant to take money out from this type of account. And the money, it comes out typically, at least yearly, because it's a mandatory withdrawal. So every year you have to take something out, and there's a whole schedule that the government determines how much you have to take at a minimum. And there is some tax implications there as well. So we'll get into the first portion here, which is that minimum table here, Kevin, and you can walk us through this. What do we see on the slide here?
Yeah, basically, as you just said, the difference between the RSP and the RRIF is the RSP is a savings plan where it's all tax sheltered. You never have to take it out. But as soon as you convert it over to a RRIF, which is basically moving it from one side of the ledger to the other, as it looks like, now you must start drawing an amount out. And as we've seen, it's all based on your age for percentage. So depending on what age you are, you have to take a certain amount out. And the older you get, the more you have to take out, because the government wants to make sure they get some tax off that. But if we're taking a look at it, as you've mentioned, the minimum amount that must come out, as opposed to the RSP where there's a tax automatically, you can take the minimum amount out of your RRIF without having to pay withholding tax on it. So that's a big advantage. Sometimes people don't want to pay the tax up front. They'd rather pay the tax if it's owed in April when it's due. So this is a big thing that they can deal with. So if we take a quick example of the 71 there, if somebody made 100 grand or had $100,000, should I say RRIF, and they took out the minimum, that's $5,280. That whole amount could come out without tax. Now, that doesn't necessarily mean it has to. You can put a tax rate on it, say 10%, 20, 30, whatever the case may be, but you can draw that minimum amount out. So that's part of the thing that you have to look at and how the percentages work. Now, how does this work if I want to take more out, Clint?
Yeah, again, if you wanted extra amounts, this is the minimum. Let's say you wanted to take that $100,000 RSP, that $5,280 minimum, which is the 5.28% at 71, but you wanted 10 grand. You can do that, but the extra amount, the amount over the minimum, is going to be taxed, and it's going to be taxed at the same withholding tax rates that we showed you earlier. So that extra amount will just go into the category. So that extra amount's over 5,000. Well, you now have to pay 20% withholding on that extra bit. Now, again, as Kevin mentioned, you can decide to pay the tax on all of it if you like, but it's optional, the withholding tax on the minimum payment. Anything above the minimum, the withholding tax will kick in. And important to mention, just like an RSP, the overall tax you end up paying is always based on your income. So when you file your tax return at the end of the year, they'll add it all up, see the tax you've already paid, and determine how much you should owe or maybe get a refund. But it's always going to be based on your income at the end of the year. The withholding tax, whether it's for an RSP or for a RRIF, it's just the government's way to get a little bit of extra income up front to make sure they get some of the tax right off the hop. And I'll mention this, Kevin, we had a T4 RSP. You also have a T4 RRIF. So similar to an RSP, you get that slip usually in that February time period based on the prior calendar year. Same thing with a RRIF. So you take money out of RRIF, you will get a slip early in the year that shows you all the withdrawals, all the tax you've already paid, and you can add that to the pile of slips that you eventually give to your accountant when you file the tax return. Anything else you want to add when we're talking withholding tax here?
Yeah, basically that's covered a lot of what we wanted to do, just to give you a clear definition as to what the withholding tax is. A lot of this planning as to how you want to take how much out of your RRIF, when should I take out of my RRIF? These are all financial planning questions we can help answer for you. But again, each person's individual circumstance is going to be a little different depending on how it works. But yeah, otherwise, we want to make sure you get a clear understanding of the withholding tax. I think this describes a lot of what it is, what percentages go on, and when you have to go between those brackets. Other than that, I'm pretty much finished. If you need to get in touch with us, by all means, get in touch with us at our website. Go to chat with Clinton and Kevin. We're more than happy to answer questions on withholding taxes, RRIFs, anything else you can come up with. That's all I can think of. Clint, final points?
I think we covered it all. We'll be back again with another video. If you do have more questions, let us know. Until then, everyone stay safe. Take care.